Welcome to the weekly update, where I'll go over the action in the market for February 13th through February 17th, and then we'll see how things look for February 21st through the 24th. Please be reminded that on Monday, the markets are closed in observance of President's Day, so there'll be only 4 trading days in the upcoming week. Let's go back and talk about what happened. On Monday, the S&P did fall below 4,100 during the day, but then buyers came in. There's a lot of this buy the dip mentality that's been going on, and that has held up pretty well until the latter part of this week. Then on Tuesday, we had the CPI come out, and that was the big report of the week. It just showed that the month-over-month inflation was not very pleasing to the market. It showed continued deceleration on a year-over-year basis, but there's this thing called the services inflation, and if you take out energy, it's up to 7.2% on a year-over-year basis, where last time it was up 7%, and this is causing a lot of concerns in the market. Yet again, the S&P briefly went below 4,100, only to have dip buyers come in and push prices back up. Then on Wednesday, we had the retail sales report that came in stronger than expected. Investors then also stepped in to buy the dip. You can probably hear a little bit of sarcasm in my voice. I'm not a big fan of buy the dip. It may work, but it may work 9 times in a row, but that 10th time can totally wipe you out. Because what is a dip? Who defines what a dip is? A lot of times people are doing this based on emotion or based on a hunch or based on some kind of intuition, and they may be right just enough to justify what they're doing. Then they get in with some kind of confidence and everything ends up turning at that point. That's just where I come out. Then on Thursday, we had PPI that then came out stronger than expected, and there are concerns now that this scenario that the Fed may be close to ending their rate hikes, and that at some point they may start to cut interest rates. Well, a lot of that was thrown out the window after these back-to-back stronger than expected economic reports. We did have some Fed officials comment on Thursday where Cleveland Fed President Mester, who's not an FOMC voter, that she advocated a 50 basis point rate hike back at the February 1st meeting. Then we had St. Louis Fed President Byrd, who's also not a voter, said that he wouldn't rule out supporting a 50 basis point rate hike at the March FOMC meeting. Then Fed Governor Bowman came out, who is a voter, and said that rate hikes should continue until a lot more progress has been made on inflation. Of course, it's kind of open-ended to what does a lot more progress mean. Also on Thursday, we got back down that 4,100 level again before we saw buyers coming in. And it looked like it was going to take prices a lot higher, but then during the last hour, we saw a reversal and we fell back down below 4,100. So this is one of those buy the dip opportunities that kind of came back to bite investors. Then on Friday, the S&P was down and it closed near the best levels of the day. We gapped lower, spent some time going down, and then came right back up to about where we opened. On Friday also, that's more positive, the Dow and the Russell 2000, which are small caps, they had small gains on the day. So for the week, interest rates were up and the dollar was also up, and both of these could be providing some headwinds to stocks. The energy sector, which had been the real darling of 2022, it was down 6.9%. Oil also fell under $80 a barrel, and it's currently at $76.57. So for the week, the S&P was down 0.28%. Not a real big move overall. But volume is below average, and we've been seeing that in the daily charts. It's just showing a real lack of conviction, either on up or down days. The technicals, they're still positive overall on the weekly charts, but we're starting to see some weakness enter because everybody is fixated on inflation and interest rates, which are producing growth concerns not only in the US, but worldwide. Our trend is still weakening. We're below 20 with the ADX on the weekly chart. It is positive with the green line on top, and I'll show you a chart of that. Here's the action going back to Monday, where we saw a pretty nice little advance in Monday's session and closed just about at the high. Tuesday ended up being more of a roller coaster. We gapped lower because the CPI was not well received, but buyers came in, pushed prices higher, then we went all the way down. We set a base at about 4,100 before bouncing back up and ended up having a fairly positive day. Then on Wednesday, we gapped lower and then inched our way back higher and ended up closing at the high. Thursday, we gapped lower, came all the way back up to this dark blue line, which is the daily pivot, hit that a couple of times. We were not able to break through that, and this is the late day weakness that we saw. Then on Friday, we gapped lower, came down to 40.50, which seems to be a new support level. Bounced back up, came back down, bounced back up, and you can see from the chart we closed just about where we opened for the session. So that could be taken as positive, that we were able to repair a lot of damage during the day. For the week, the Dow was down 0.1%, the Nasdaq was up 0.6%, the S&P down 0.3%, and the small caps were up 1.4%. We like to see a lot of good leadership in the small caps, and that'll often give some good support to the S&P 500. Here is the week showing that the small cap index was up, and this just measures the 5 trading days. It doesn't go from Friday to Friday. It goes from Monday through Friday. The mid caps were down, and all the other indexes ended up being down, with the S&P leading things lower. Going back year to date, we still have the Nasdaq 100 and the Nasdaq, which are in the lead, even though they've given back a lot of those gains. And all of the other indexes continue to be positive going back to the beginning of the year. Going back to the all-time high, all the indexes are still down, with the Nasdaq 100 and the Nasdaq leading the way lower, even though they've repaired some of their losses. Looking at sectors for the week, we had discretionary and utilities doing the best. And then way down at the bottom, energy, which really suffered some declines in the past week, followed by the real estate sector. This looks at the sectors over the last 5 trading days, where utilities, discretionary, industrials, staples, and communication, with a little bit of an uptick with healthcare. Well, we saw energy way over on the right-hand side. It had the worst week. Year to date, we have discretionary, communication, and tech, which are up the strongest. And we have healthcare, utilities, and energy, more defensive sectors, including staples. They are down since the beginning of the year. Going back to the all-time high, energy is still doing the best, followed by the industrials, utilities, and staples. And then way over on the right-hand side, we have discretionary and communication, which have really suffered, but they've pared a lot of their losses. Looking at sentiment, from Thursday to Friday, we didn't change. We're currently reading 69, which is in the positive category. They label this as greed. We tend to go with that. Where we look to use this as a contrary indicator is when we get to extreme greed readings or extreme fear readings, and currently we're not at that point. However, if you look at the historical chart, we did get up to the extreme positive reading, and we've been coming back down since then. Here's another sentiment gauge showing pretty much the same thing. We're not over in the frenzy side, which is red. We're just over in the positive side of the orange. The VIX ticked up a little bit this past week. It was able to get back above 20, even though it declined this past week, both with the line chart and with the bar chart. But fear overall is still not very prevalent, and we have a lot of complacency, and that's why a lot of people are suggesting that we could decline further. The active asset managers, they're getting kind of extreme now. We have 2 readings above 80, and even though these are professionals, they tend to act with emotions just like everybody else does. And when we start to get too extreme, we tend to use that as a contrary indicator. Up on top is the historical chart of the sentiment index that I showed just a minute ago. And then down on the bottom is the S&P 500, just showing how we often hit a top when we also hit a top with the sentiment index. This is put out by realinvestmentadvice.com. I showed this in last week's video. This is just labeling some other areas of support or resistance, and I tend to follow these in other charts. We have this trend line that we were finally able to get above. Well, if we continue to come back down, they have another dashed support line in here. We also have the trend line, and we also have the 50-period moving average above the 200-period moving average, so that's a golden cross. And if prices continue to fall, either one of these areas may act as support. They're also suggesting that we may have a left shoulder, a right shoulder, and a head, which is a head and shoulders bottoming pattern, which usually is very bullish for the market, even though the market seems to have hit some short-term difficulties. The right X bull bear ratio is kind of in between right now. You have a lot of folks that are in the bearish funds and a lot of folks in the bullish funds, not showing any kind of an extreme reading. The latest survey from American Association of Individual Investors shows that we're slightly above zero, we came up and then came back down. This pretty much follows the market. If we have an up or a down week, this will go up or down because individual investors tend to react to what's happening instead of proacting. We really pay attention to this when we get extreme negative or extreme positive, and we're not seeing that currently. The Ulcer Index also suggests that there's a lot of complacency in the market. Looking at the economy, this is the spread between the risky and not as risky loans. It's actually going down. If we were going to run into some economic difficulties, according to this chart, this should be spiking up, and that's not what it's doing. Another one that we look at is the National Financial Conditions Index. When we're below this black line, things are doing okay. When we start to get above that, that means that there are concerns. Well, we've been declining below this black line for some time. Here's another one to keep an eye on. This is showing how banks are tightening their standards for loans, and this is really starting to spike up. I don't have a chart of this, but we'll also keep an eye on the default of loans as well, because sometimes there's a correlation between the two. So this is giving us a little bit of concern. You can see other times when this spiked up, that usually happened before we ended up going into a recession. Another thing that Edward Yardeni put out is for the year 2022, he posted a chart saying that foreigners bought 1.6 trillion in bonds, and that helped to keep interest rates a little bit lower, even though it was a very difficult year for bonds. Looking at inflation, on Tuesday we had the CPI. The official number that we're told is this red or yellow line, and you combine them to get orange. And that report came in at 6.4%, where last time it was at 6.45%. So it did come down a little bit. If you go back to how it was calculated in 1990, we would be at about 10% inflation. On this next chart, if you go back to how it was calculated in 1980, we would be at 14.48%, which did decline from 14.52. But we can see a real gap between how it used to be calculated and how it's calculated now. Additionally, I'm putting a link to an article from thehill.com. It talks about some recent adjustments that they're making to the CPI, which may give it some more elevated numbers going forward. The Cleveland Fed also comes out with a thing called inflation nowcasting. I'll probably only deal with these charts in the weekly videos because they tend to go sideways a lot. This is a day-by-day expectation of what they think inflation will be. The blue line is the PCI, and the red line is the PCI core. The green line is the PCE, and the yellow line is the PCE core. So we just keep an eye on these for what the market is expecting inflation to be. As of right now, at the March 22nd meeting, there's an 81.9% chance that interest rates will be at 4.75% to 5%. That would mean another 25 basis point move. What we're seeing in this chart is a tick up in the 5% to 5.25%, which would be a 50 basis point move. If we really see a lot more stronger than expected economic reports, we could see this percentage really start to go up. The Fed continues to wear down its balance sheet. A lot of those things that it bought to stimulate the economy during the COVID crisis have now been tapering off, and that is producing a lot of headwinds for stocks because when it was adding a lot of liquidity, that really helped the markets. Now that it's coming down, that's been providing a real headwind for markets. Looking at breadth, we're still holding up okay. Based on price and volume, we're above an advancing moving average, both on the top chart, which is price, and the bottom chart, which is volume. The advanced decline ratio is still above the zero line, so that's positive overall. New highs, new lows didn't really see much of a change this past week because we've been chopping more or less sideways. But our 4-period simple moving average, even though it's rolling over a bit, is still positive. And we're flat to slightly down with our 10-week moving average. Accumulation distribution is still positive, even though we're coming back down to this moving average. It's still above that moving average. Looking at our trend, we've dropped below 20 with the ADX. That happened a few weeks back. We're starting to turn back up. We're still below this moving average, but we still default to the positive side because the green line's on top, even though it is declining. The Arun saw a little bit of an uptick this past week. This red line are sellers, the green line are buyers, and the measurement down below is an oscillator comparing these two, and it had been flat for quite some time. Well, it's finally ticking up ever so slightly, so that's a little more positive. The mass index, we're not getting a signal from that chart. Looking at the daily chart, we have a pretty friendly candle for Friday's session. To open, go down, and then come back up and close about where we opened could be seen as positive. We need to see some follow through when the market opens again on Tuesday. We did break down below the December highs, and we're coming back down and testing this other support level. We have a recent golden cross on the daily chart, and we're still above this downward sloping trend line. And down at the bottom, we see where volume has pretty much been below average for the entire week. We're a little bit above the midpoint in our trend channel. And we're a little bit above the pivot, which lasts for the entire month of February. If we can stay above this P line here, that is more positive. Above that is positive, below that is negative. We're still above the 50-period simple moving average, which equates to a 200-day moving average, since this is a weekly chart. Long-term trend, we're not seeing a golden cross yet. We already saw that on the daily chart. It takes a little bit longer for it to be confirmed on the weekly chart. Bullish percent index, after giving us an extreme positive reading, has been coming back down. Chaikin oscillator is also declining, but it's still above zero, so that's positive, but it is declining. The Chaikin money flow continues to advance, so that's positive. The force index is still above zero, even though it's shown a little bit of recent weakness, but that's positive. The McClellan oscillator, this is negative. We're below zero, even though we ticked up slightly. The summation index based on price is now declining, but still above zero, as well as with volume. After giving us almost an extreme positive reading, it's now been coming down. So we're seeing a mixed picture in this chart. It's still positive, but there's been some recent weakness. All of our weekly oscillators were rolling over with the slope. The TSI still hasn't rolled over yet. The MACD is still going higher, and the PMO is going higher with the PPO, the TRIX, and the KSD. These are still holding up okay. We're starting to see them roll over on the daily charts. If that continues, then eventually we'll see them roll over on the weekly charts. Swollen trading oscillator, based on price and volume, we just ticked back slightly above zero, so this is positive. And here's a PMO study showing the PMO continuing to rise. Even though we saw a decline based on price and volume, we're still above zero. Here's a PMO study with those PMOs that are rising, ticked up slightly this past week. The buy signals are declining, and the PMOs above zero are also declining. The RSI, going back 14 weeks, we're still above 50, even though we did decline. So it's positive, but showing some recent weakness. The special K is still positive. The black line is above the red line, which is a moving average. The Stochh RSI, after giving us an extreme positive reading, is now starting to come back down. This is an official overbought signal. And the Williams percent are the same thing, getting extreme positive and is now dropped back down. The vortex is still positive with the green line on top and the red line on bottom, but we're seeing an increase in sellers and a bit of a decrease in buyers. The ultimate oscillator is still positive, even though it's showing recent weakness. It's above 50. The money flow index is still slightly below 50, even though it advanced in the past week. So that's negative with some positive movement being shown. The Bollinger Band's not really giving us an extreme reading right now with our percent B indicator. The rate of change going back one period, we were down just 0.28%, so we're not seeing much of a rate of change from one week to the next. Going back 50 weeks, we're still trying to bounce up after going back and testing the COVID lows. The Kopik curve, after giving us a buy signal in about the midpoint of November, is now starting to roll over. It doesn't mean this is a sell signal, it just means that this buy signal could be going away. The S&P is still holding up with our longer-term charts. We're above both moving averages, and we're still above this 38.2% retracement. We're still hanging in there with the positive chart with the Heikin Ashi with open bars. The Kegi is still positive with black bars that are advancing. The Renko is still positive with open blocks. The ease of movement, a little bit of a decline from one week to the next. Even though we're positive and above zero with the 14 period, we are seeing some recent weakness. Nothing new in the point and figure chart. We're still working off of an ascending triple top breakout that was generated on January 30th. The three-line break continues to be positive with open bars. Our elder impulse system has remained neutral. Our parabolic SAR on the weekly chart continues to be positive with the dots underneath. On the daily chart, it turned negative, so we're seeing a bit of a conflict. Looking at the S&P, the mid cap and the small cap, not really seeing any divergence. They're having a tendency to move in generally the same direction. All stocks, after giving us a recent golden cross, has shown some weakness this past week. The mid cap's also a recent golden cross, looking a little bit more positive. The small cap's also a recent golden cross. The Dow, recent golden cross and holding up so far. The Nasdaq has not given a golden cross yet. We'll have to see if it can show some improvement. And the same thing is true with the Nasdaq 100. The Wilshire 5000, another broad measure of the market, haven't shown a golden cross yet. But if you look at the NYSE, we did see a recent golden cross. The FANG stocks not really generating a golden cross at least yet, but showing some improvement. And ARK has a lot of damage to repair before it gets to a golden cross. The biggest software companies, they were up 3% on the week, but not coming up to a golden cross yet. Looking at Dow theory, we're basically looking for any kind of divergences here, not really seeing anything. The utilities breaking down could be somewhat of a concern, but this is more of a defensive area, which could give some support to the stock market. Some broad market measurements, the CRB index, after seeing a death cross, it continues to decline. Copper is still in an overall uptrend. Gold is also in an uptrend, even though it's coming back down to its moving averages, and the same thing is true with silver. Oil is now at 76.55. The dollar, after really coming down pretty hard, is now starting to bounce back up on the weekly chart. We're still getting close to a cross with the bond ETF. We haven't crossed that yet. We did see that on the daily chart. We're waiting to see if that can be confirmed on the weekly chart. After really coming down, the yields have now been really going back up, and that's providing a lot of headwinds for the market. Here's the MOVE index, which is the VIX for bonds. After coming back down, it went up slightly this past week. I can't really do an awful lot to this chart except look at it. I wish I had the data available to me, but I just don't have that right now. Here's a weekly chart showing how US, UK, and German rates are starting to go back up. Japan, even though they're going up, are still a lot lower. They have their own little scenario they're trying to work through. Looking at our intermarket analysis chart, we still have oil in the lead, followed by the dollar and gold, which is barely positive. This is going back to the beginning of 2022, where stocks and bonds have been seeing some weakness. The bond to S&P 500 ratio shows that bonds are continuing to underperform stocks. And this also confirms that on a monthly chart where stocks are outperforming bonds. Gold, after really starting to outpace the dollar, has now been going back down as we're seeing some recent strength in the dollar. And gold to the S&P 500, still in an overall uptrend, but showing some weakness in the ratio. Low volatility stocks, after really outperforming for much of 22, have been showing some recent weakness, but in this past week, they're going back up as we saw some price pressure enter into the stock market. Growth has really been underperforming value. Every time it looks to be improving, it seems to turn back down. The Nasdaq 100 to the S&P 500 still in an overall downtrend, but showing some improvement. The S&P 100 to the S&P 500 is still underperforming. Discretionary is still underperforming staples. And energy continues to outperform tech, even though energy got hit pretty hard this past week. Looking at some very long-term trends, this is the NYSE breadth thrust, and we generated a signal back in October of 2022, and we've been bouncing up off of that. And so far, this is holding up, and this has a perfect track record looking out 1, 2, and 3 years. What you see here is a monthly chart of the 30-year bond price. What we're watching is the bond ratio to the CRB ratio, and it's starting to turn back up, which means bonds could be starting to outperform the CRB index. The NYSE composite monthly and then the Copic curve on the bottom, we're still looking like we're turning back up. But these are very long-term charts. They're monthly. Here's the NYSE composite looking at the NYSE record high percent index after bottoming out, still continues to advance. And the percentage price oscillator, or PPO, it is starting to turn back up when looking at the monthly S&P 500 chart. Here's the S&P 500 ratio to the CRB. It's also starting to turn back up. Up on top, you have a monthly chart of the S&P 500. So what's our outlook then for the upcoming week? On Tuesday, we have the IHS Market Manufacturing. That's one report. And then we'll get the Services report. And these are Purchasing Managers Indexes, or PMIs. We'll get existing home sales. Then on Wednesday, we have the MBA Mortgage Applications Index. And then the FOMC meeting minutes will be released at 2 p.m. Eastern. On Thursday, we'll get the second estimate for GDP and weekly jobless claims. Then on Friday, this will be kind of the big one. We get personal income and spending with the PCE prices and the PCE core prices coming out. This is the preferred inflation gauge that the Fed likes to use. And we'll also be getting new home sales. And we'll get the final reading of consumer sentiment. The technicals, you can see here, we're showing a lot of strength but recent weakness. We want to see if this can hold up right now on our weekly charts. We're seeing more weakness now on our daily charts because we fell through the bottom of a trading range that we've been in for the last couple of weeks. And if that continues to send the S&P lower, that could bleed over into the weekly chart showing some weakness as the market continues to be fixated on inflation and interest rates. We have one Fed speak coming up this week. It'll be on Friday the 24th at 10:15 a.m., where Governor Philip Jefferson will be giving a speech. Looking at the statistics based on the Stock Traders Almanac for Monday the 21st, it's not very positive. The Dow is up 38.1% of the time. That means it's down a lot more than that. The S&P is up 33.33% of the time, so that means it's down 66.6% of the time. And the Nasdaq is also only up 38.1% of the time. So based on historical factors, February 21st ends up being a rather negative day. And then the other areas that I talk about periodically, and the market also likes that we're split between Republican and Democrat in government. Here's the Stock Traders Almanac chart, just showing how we're still into the sweet spot of the 4-year cycle. But again, it doesn't mean we're going to go straight up. There could be some serious bumps that we encounter. And then this is also a bit outdated, where we're in the first term pre-election year, and we're also in the pre-election after we had a bear market in 2022. This just goes forward and tries to give us an idea of historically how have the markets acted under this current environment. Our scenarios for Monday's session, kind of leaning a little more towards the down scenario, even though our ADX continues to be positive with the green line on top, but the technicals are showing some weakness. So it's kind of hard to go with the positive one, even though according to our ADX, that's what we should do, even though we're turning more negative. We can't really go sideways right now because on the daily chart, the ADX is weakening. It's dropping below the moving average, but it's still above 20 and the green line's on top, so it is positive. Thank you. I hope you found this helpful. Please feel free to check out some of the daily briefs that I post. I'll also be posting the intermarket analysis video, another video that I call a deep dive video, which are all the charts that I don't really cover in these videos. And then I'll also be preparing a supplemental video, which mainly looks at charts from isabelnet.com.